Welcome back to CEO Money. I'm Michael Yorba, your host. Thanks for being here. All right, we've got John Kosar, Asbury Research. He's the Chief Investment Strategist. John, welcome back to the show. How you been?
I'm good, Michael. Talk about timing, right? S&P's down 50 as I'm looking at my screens.
Right. Yeah, well, it's not surprising. I mean, and it's not like it's unwelcome. There's a lot of people been hoping they get something like this.
Oh, I agree. I mean, I think people have a short-term memory with markets, and you go a couple of years where you don't have a correction, and then the market is down. I think we're down 4%. And it's like the end of Western civilization, where in fact, my belief is, unless there are geopolitics around the corner that nobody can see, that would have to do with a war or something like that. As you said, I mean, this is a welcome little respite that should offer some opportunities.
There's some people that pulled a lot of money off the table as this thing was going up. There's some people that are bringing a lot of money back from foreign shores that were like, oh, finally, something I can work with.
Yeah, I agree. I mean, I don't think it's over yet.
I don't either.
We work with a lot of folks that are high net worth individuals, 50s, 60s, who are not as concerned with trying to hit home runs, but trying to keep themselves from, going through another '08, which devastated a lot of people. I know people
Right.
that, went through that, and a lifetime of savings was gone. So our focus is to kind of make sure that we don't get run over by those things. And that being said, I think another 50 points or so in the S&P is feasible. A little fear is good in the market. You get people afraid. The markets are funny. It's when everybody's getting out is when you should be getting in, and when everybody's getting in is when you should be getting out. But another 50 points here over the next week or so, get the S&P down into that 2,700-ish area. I mean, I have more specific levels, but for our conversation, I think that's a good fat round number, 2,700. And I'm going to be looking for reasons to put more money to work.
Yeah, that's on my pardon me, on my daily chart. That's that's just the 50-period average.
Absolutely,
It's nothing
that's what I'm looking
historic.
at, and there's some other stuff going on down there too, which kind of makes that level a little more stout.
Yeah, I'm with you. We don't have to get into the weeds with some of the people who aren't as technically inclined as you and I are, but I agree with you. Okay, intermediate term stock market direction over 2018. Got any thoughts there?
I do. Again, there's a lot of geopolitics out there, so I think you always need to be a little bit more careful now than you might have had to be in years gone by. But I have unmet targets in not the S&P, but in assets that are – we do a lot of quantitative stuff here without getting in the weeds too much, but sometimes you don't have a target in the index you're trading, but you could do – studies that will show you stocks or indexes that are positively correlated to the one you're trading, like the S&P 500. And bottom line is, I've got unmet targets here, another 10 to 20% up above the market. And I think a reasonable time frame would probably be late this year, early next. And we also have an economist we consult with, been sharing information for 25 years. He sees the likelihood of a recession over the next year at less than 5%. So the economy is good. The global economy is good. You're seeing strength not just in this country but all over the world. You're starting to see inflation tick up a little bit. You're starting to see interest rates tick up a little bit. The yield of the 10 years, like around 283 or something like that today. People go, oh no, interest rates are going up. No, that's the bond market telling you that it thinks the economy is strong enough to support a more normalized interest rate. So bigger picture, I like the market, and I think you look for these periods of minor terror to put some money to work.
I'm a technician first and foremost, and I've been a technician since 1980 in this industry sector. But looking at it from a fundamental point of view, and I bring that up just so that you can come out with me on this. What do you think is going on a fundamental basis? Is it the perfect storm? Are they managing inflation correctly? Are they managing interest rates correctly so that they're actually going to be able to create more strength through the proper management of our financial system versus unbridled, just let the market go where it needs to go? It seems to me that this is very managed, and they're finally, in my opinion, they finally got it right.
I would disagree with that slightly. I think that this administration is interested in strong growth,
Yeah.
almost with a, let's go until they flick the lights and they throw us out of the bar kind of a mentality.
Really?
I am looking at, tax cuts. They're kind of geared to help corporations. There's a little cookie in there for, the blue-collar guy for the first couple of years.
Right.
But after that, these things are really geared to help corporations. He's talking about he being Trump, he's talking about a program to fix the roads and bridges. That tax plan was $1.5 trillion. So, that's going to be a tough row to hoe to get that passed. But the new Fed chair is a very dovish guy that's going to tend to err, with leaving interest rates low. So if you look at all of the policies that are being installed here, they're all geared towards more growth. Now, if you goose the economy, this is 8 years now and we're straight north. You goose the economy too far, and I think you get into a bust situation again, which is why I think especially retirees really need to be careful and make sure you don't get, carried out on your shield. There's ways to protect yourself on the downside, but that's where I would disagree with you. I think the policies are going to exacerbate an already good global economic environment. What I'm afraid of is that we kind of light this candle a little bit too hot, and at some point over the next couple of years, we have to deal with a bear market.
And do you think that's going to be a severe one?
God, it's so hard to say. The market's funny. It tends to be mean reversion type of market, and what that means is the end of last week, the S&P 500 was 14% above its 200-day moving average. What does that mean? A lot of people look at the 200-day moving average as what the major trend is. So I use that, and I like to see how far the rubber band is stretched, so to speak. So 14% was like a 10-year extreme, and that occurred last Friday, and look what we're doing now. Are they related? I think in part they are. And what I'm afraid of, where I'm going with this to answer your question, is the farther you get away from the mean, the more you have to travel to get back to it. So, yeah, in that we haven't had a severe move down since '08, my feeling is that when we get this move, I think you could be looking in the 20 to 25%. Again, I don't have a crystal ball, so I'm just kind of spitballing it a little bit. But I think 20 to 25% amid these conditions would not be outrageous.
It would scare the heck out of everybody, but those that are longer-term investors who've been prudent with their profits, I suspect would be just wringing their hands.
Well, yeah, the trick of it, the market inherently goes up. It has I have data going back 100 years. It goes up. So the trick with the stock market it isn't difficult to make money, but you got to know what you're doing not to lose it. We actually built a model. It's called Correction Protection Model, CPM, and its only job is to tell you when you've got a risk-off situation.
John, we need to stop right there. Let's take a break, but let's continue this conversation on the other side, all right?
Okay.
We'll be right back with John Kosar, Asbury Research. This is CEO Money, and the segment is brought to you by Lots of Yachts. Welcome back to CEO Money. And Michael Yorba, your host. Thanks for being here. All right, we have got John Kosar. He's the Chief Investment Strategist for Asbury Research. All right, John, we were getting into it pretty deep, but I'm sorry, I just got off sideways on this thing. Size, style, individual stock names. Let's go there today.
Individual stock names. I'm actually sitting at my desk here so I can take a look at some of the stocks that we like. And again, I mean, this is a tough time to be picking stocks when the market's getting murdered.
Yeah, well, no, this is the great time to pick them because you're looking for support. But let me wait, John. Let me put a disclaimer out here first.
Please.
These are not recommendations. This is for entertainment purposes only. These are two guys who have traded the market for quite a while talking about their thoughts.
Thank you.
You're welcome.
Couldn't have said it better. When the market's going down, people look for non-correlated things to get invested in. What does that mean? I mean, stuff that's not moving up and down with the S&P 500. One that I'm watching that shows some promise is gold. Trump administration has a low dollar policy, which is conducive to higher interest rates, which we're seeing. And it's also conducive to, obviously, a lower dollar. When the dollar goes down, inflation talk tends to pick up, and stuff like gold does better. So we're looking at gold as a possible place, especially if the stock market move down is going to last a little bit. Edward Life Sciences is one that I've liked for a couple of weeks. It had a big day today.
Symbol?
That's another one.
No, what's a symbol?
EW.
Okay, got it.
They make heart valves.
Man, big gap today. Okay.
Huge gap today. Came out of the gate real strong. It was 10% higher on a day where the market's getting its butt handed to it. Did well. It's backed off with the rest of the market, but it's still up 4% on a day when the S&P is down almost 2%. So that's one that I'm looking at. I think it's got legs. And again, making valves. All of us, and I think you and I are probably in the same neighborhood there, all the baby boomers, 50, 60 years old. I mean, everybody needs hips and valves, and that's what drives the market. There's a lot of demand there, and it's more of a healthcare. It's more of a defensive stock that tends to do well in all markets. So given the climate today, I think those are two worth looking at.
Okay. All right, sounds good. Last but certainly not least, direction of interest rates and global equities. I want to hear this.
Oh, sure. We've been looking for higher rates since the yield of the 10-year was at 240. We had levels of 240, 263, 283, and 304. We are challenging 283 now. This is the yield of the 10-year. The 10-year is the benchmark that most people look at for long-term interest rates. And it's also used to spread against corporates and agencies. So it's kind of a one-size-fits-all benchmark. Let's see, looking across, we're at 285 right now. The next level to watch is 304. And once you get above 3%, you're going to get a lot of buzz because it's a big fat number, and CNBC is going to be talking about it, and the Journal and Financial Times and so on and so forth. But I think we go at least to 304 and possibly another 20 to 25 basis points higher, which would be like 325, 330. I don't think we're going to run away, but people lose sight of the fact that we've been at generational lows in interest rates for a long time. So a move to 3%, although it seems like a lot, I think just getting back to the mean, I think the 10-year mean off the top of my head, or the 100-day or the 100-year average in the 10-year is just off the top of my head like 4.5%, just to put that into perspective a little bit. So interest rates, if they get too high, obviously they're a damper on the economy, but when you're coming off of generational lows and interest rates go higher, all it tells you is that the bond market, which tends to be a little bit more forward-looking than the stock market, thinks that the economy is getting better and can actually support higher rates. So I look at this as being positive for the economy, positive for the market.
That's what I was saying earlier in our conversation, that I think that they're managing it correctly, because up till now everybody was freaking out that, oh my God, interest rates can't do it. Well, you know what? That financial sector, it really puts a lot of juice back in there when they can make more money on the spread and manage the dollar, manage inflation correctly, rather than just hope something happens.
It sure does. The trick is going to be once we get to 3 to 3.5 in the
Right.
10-year. That's 3% to 3.5%. We start getting up above there, and I've been doing this almost 40 years. Once you start getting above there, then I think along with that, you're going to see a tick up in CPI and in some of the other inflation gauges that people watch, the government watches. And above there, I mean, we've had interest rates at zero for a long, long time. And historically, once you get a little bit of smoke and some fire there, we could run interest rates up again. I don't think it's going to be like in 1980 with a 21% prime, but I think you can certainly see interest rates in the 10-year go back to that 100-year average of about 4.5%. And I don't know that that's really a bad thing. I think it's once you start getting appreciably above that long-term average, that's when inflation becomes a problem, and that's when you have difficulties. But we could be years away from that.
We could. We got less than a minute left. India, what's going on?
I've been in and out of the Indian market 3 times over the past 12 months. INDA, INDA is the ETF. I just off the top, and I only know this because we just closed out. I was looking for 38 there, and it took me 3 times to get there. But I think we took out 7% the first time, 8 the second, and 6 or 7 the third. That market has outperformed the S&P for the past year. It was one of our best calls. It was not only an outperformer, but we caught the whole move up. It's hit all of my initial targets, which doesn't necessarily mean that a top is in place, but this is not a place to chase India, which is Bombay Sensex Index, is, the cash index. We get a nice break in the market here, and I'm looking at that again, but I don't want to be chasing that after it's outperformed the S&P, and it's just been a skyrocket for the last 12 months.
Got it. We got to go, John. Thanks for being a guest.
No, it was nice to be on. Thanks for having me.
My pleasure. John Kosar, Chief Investment Strategist, Asbury Research.